Hello, my friends. Listen closely, because what I'm about to say is not comfortable, and that's exactly why it matters. The biggest safe asset on Earth just flipped roles. The US dollar used to be the lifeboat people ran toward in a storm. Now it's starting to look like the storm itself. And if you're sitting in cash thinking you're playing defense, you might actually be standing in the middle of the field with no helmet on, while the game is coming straight at you. Here's the uncomfortable truth. The risk isn't out there anymore. The risk is the paper you're holding. The risk is the promise. The risk is the IOU. And the more the world wakes up to that, the faster the exit becomes a stampede. Before we go any further, real quick, my YouTube stats show a huge chunk of you watch these videos, but you're not subscribed. And that hurts the channel more than you think. If you value this kind of breakdown, hit subscribe right now and drop a quick comment, even just our John AG, so the algorithm knows this isn't copycat noise. Now, let's set the stage, because the next few minutes will either snap your perspective into place, or you'll realize you've been looking at the whole chessboard upside down. All week, the headlines have been playing a familiar game. Everything is fine, markets are normal, nothing to see here. But behind that calm voice, the numbers are screaming. And when numbers scream, history listens. Gold has been acting like a fire alarm. Silver has been acting like the guy who kicks the door open and yells, "Get out, now." And the scariest part, in at least one major physical market, silver has already pushed past the psychological $100 level. That's not a meme, that's not a prediction, that's a signal. And I want you to really sit with what that implies. If physical silver is pricing above $100 in one place, while the official price in other places looks lower, then we're not looking at one global market. We're looking at two different realities: paper reality and physical reality. And when those two split, the gap doesn't stay quiet for long. So the big question is, are you holding the asset or are you holding the story? Because in a system built on confidence, the story is everything until confidence breaks. And when confidence breaks, the story is worth exactly zero. Now, I'm going to walk you through three things today. First, why the dollar is increasingly being treated like a risk asset. Second, why gold and silver are reclaiming their true safe haven status in a way that most people won't understand until it's too late. And third, the trap hiding inside the idea that central banks can save a currency just by buying gold. And yes, there's a trap, a big one, and it's the reason so many people keep making the same mistake over and over again. But before we dive deeper, if you want daily updates, quick posts, and my personal analysis that I don't always share on YouTube, including instant voice notes when something breaks, there's a WhatsApp channel link in the description. Join it. It's the fastest way to stay ahead when things move overnight. All right, let's talk about the dollar. For decades, the world treated US Treasury debt like the purest form of safety, risk-free. That phrase got repeated so much it became a prayer. And in past crises, money ran into dollars like people running into a bunker. But what happens when the bunker is built out of paper? You already know the core problem. The US runs massive deficits. It rolls debt. It issues more. It leans on the rest of the world to absorb it. And it assumes, because it has assumed for a long time, that global demand will always be there. That assumption is the foundation. And foundations don't crack loudly at first, they crack quietly, then suddenly. Here's what's different now. The US is not just exporting dollars. It's exporting uncertainty. It's exporting political volatility. It's exporting policy whiplash. And when confidence becomes unstable, the world starts pricing that instability into everything. And this is where gold and silver step back onto the stage, not as investments, but as exits. Gold doesn't need permission. Silver doesn't need trust. They don't require a counterparty to keep their promise. They are the promise. Now, some people hear that and they roll their eyes. Gold is old. Silver is volatile. We have modern assets now. Fine. Let's test that confidence. When the world is calm, people can afford to be smug. When the world is chaotic, smug gets punished. And we are entering a phase where punishment arrives faster than explanations. Now, a lot of you have been asking a very specific question, and it's a dangerous one if you don't think it through properly. Could Europe dump trillions in US treasuries to retaliate against Washington? You've probably seen this idea floating around. Europe gets angry. Europe sells US debt. Europe buys gold, and the dollar gets wrecked. Sounds dramatic. Sounds powerful. Sounds like a movie. But here's the problem. Real life isn't a movie. Real life has plumbing. First, a massive chunk of those treasuries are held by private institutions, funds, banks, insurance pools, pensions. Not a single unified Europe button someone can press. Governments can influence, they can pressure, they can regulate. But forcing a coordinated liquidation of several $1 trillion worth of assets is not as simple as a headline makes it sound. Second, and this is the part most people miss, if you dump US debt in size, you don't just hit America, you hit yourself. Because in the current system, many currencies behave like derivatives of the dollar system. They trade against it, they hold reserves in it, they price commodities through it, they borrow through it, they're entangled with it. So if a region tries to weaponize a treasury dump, they can trigger a chain reaction that slams their own currency purchasing power, their own banks, their own funding markets. It's like trying to burn your neighbor's house down when your house shares the same wall. Now, does that mean no one will sell? No, people sell every day. But the idea that a central authority can casually unload $8 to $10 trillion worth of treasuries as a clean geopolitical move is much more complicated than the viral version of the story. And here's where the conversation gets even more important. Even if they did sell and then buy gold, does that save their currency? This is the part that surprises people, so listen carefully. A central bank can stack mountains of gold. It can build a vault like a fortress. It can brag about reserves. It can post photos. It can flex. And none of that automatically protects the purchasing power of the currency the public uses every day. Why? Because gold sitting in a vault is not the same thing as gold backing a currency. For gold to actually defend a currency in a lasting way, the currency has to be convertible. That means the central bank has to promise, bring your currency here, and we will redeem it for gold at a fixed rate. That is the line. That is the boundary. That is the moment the game changes. And that is exactly why most central banks won't do it. Because the second a currency becomes truly convertible, the system stops being a magic trick. The system becomes math, and math is unforgiving. If you promise convertibility, you cannot print endlessly, you cannot inflate away debts quietly, you cannot bail everyone out with fresh liquidity. You cannot keep fractional reserve illusions running at the same scale. You have to choose. And choosing means someone loses. So instead, central banks stack gold as a balance sheet hedge, as insurance for themselves, while the public is left holding paper that is still fundamentally unbacked. That's the uncomfortable reality. The institutions protect the institution. They do not automatically protect the citizens' purchasing power. Now, you might be thinking, okay, John AG, so what's the point of central bank gold buying if it doesn't support currencies? The point is survival. It's preparation. It's a quiet admission that they see what's coming. They want a seat on the lifeboat. They don't want to be the last one holding empty promises. And this leads us into the big inversion happening right now. The traditional safety net has flipped. In the old playbook, when panic hit, money ran into dollars and treasuries. Now, we are watching a world where, in growing pockets, money is running away from U.S. exposure for safety. Read that again. Away for safety. That's a psychological pivot. And psychological pivots in markets don't happen often. But when they do, they're violent. And here's the part that should keep you glued to this video. If the dollar becomes the epicenter of the next crisis, the normal crisis response breaks. In 2008, the world's crisis trade was sell everything, buy dollars. That pushed the dollar up while everyone else burned. That's why you saw the dollar spike even as the system cracked. But if the system's crack is now inside America's balance sheet, inside its debt structure, inside its political volatility, inside its monetary expansion, then the flight pattern changes. Instead of money running into America, money runs out of America. And if that happens at scale, it doesn't move slowly. It moves in waves. Slowly, then all at once. Now, let's talk about silver crossing triple digits in parts of the world. Because this is where the story becomes more than theory. A lot of people don't understand silver. They treat it like a cheaper gold. They treat it like a toy. They treat it like a speculative bet. But silver is a strange beast. It sits between money and industry. It gets consumed. It disappears. And unlike gold, a lot of silver doesn't come back. So when physical demand tightens, silver can do something that makes people's heads spin. It can move like it's escaping gravity. And that's why a triple-digit print in a major physical market matters, even if your local quote feed doesn't show it the same way. Because it tells you something very specific. Physical metal is refusing to obey paper narratives. And when physical refuses, paper eventually has to adjust, or paper breaks. Now, I'm not here to scare you. I'm here to keep you from being the person who says, I didn't see it coming. So ask yourself this. If silver is already pricing higher in one place, what happens when that pricing pressure spreads? What happens when the arbitrage becomes too obvious to ignore? What happens when inventory gets stressed? What happens when delivery gets delayed? What happens when people realize the price they were watching was not the price of the thing, only the price of a promise? That's the cliffhanger most people don't want to think about. Now, some of you will say, fine, metals are moving, but what about the digital safe havens? You've heard the argument, when the dollar collapses, people will rush into digital alternatives. Maybe. But here's a simple test. In the moments where gold and silver have been acting like emergency exits, has the digital alternative consistently behaved like a safe haven or like a high-risk tech trade? Because if something claims to be a lifeboat, it doesn't sink every time the ocean gets rough. And that's why, in this environment, the market is giving us a brutal lesson. Not all alternatives are alternatives when fear gets real. Now, I want to pivot to the political layer because this is where things get even messier and potentially faster. Economic pain always hunts for a villain. It doesn't matter who caused it. It matters who gets blamed. When the public's purchasing power collapses, when living costs spike, when retirement accounts wobble, when taxes feel heavier, when jobs feel unstable, people vote with anger. And when anger arrives, it rarely arrives with precision. It arrives like a storm. So the risk here is not only economic, it's political whiplash. If the next leg of this crisis becomes identified as an American crisis, you can see a scenario where voters punish whoever is in power and the pendulum swings hard. Then the next group comes in promising solutions that sound good and produce results that are worse. That's the pattern. That's the tragedy. And if you understand the pattern early, you can position yourself to survive it. Now, you might be wondering, okay, what do I do with this information? I'm going to be careful here. This is not personal financial advice, but I can tell you what the logic is pointing to. If the dollar is the risk asset, then being overexposed to dollar-denominated promises becomes dangerous. That includes cash sitting idle, losing purchasing power. That includes long-duration bonds that can get crushed if yields shift. That includes assets priced for perfection that rely on cheap liquidity forever. The strategy that makes sense in this kind of environment is not one magic bullet. It's diversification away from single system risk. That can mean foreign equities. It can mean value in dividends rather than pure growth stories. It can mean resources. It can mean tangible assets. It can mean holding at least some wealth outside the pure paper promise loop. And yes, it can mean owning physical metals in a way that doesn't rely on a paper claim. But here's the catch. The window to do that calmly is not always open. Most people wait for confirmation. Most people wait for mainstream approval. Most people wait until the move is obvious. And by the time it's obvious, it's expensive. And by the time it's expensive, it's crowded. And by the time it's crowded, it's chaotic. That's why the people who do well in these cycles are not the smartest. They're the earliest. Now, a quick creative detour, because I promised I'd do this. If you're obsessed with silver and you want to hear real silver-related success stories, there's another channel linked in the description. Go check it out and subscribe over there too, because seeing how other people built wealth can flip a switch in your own mindset. And speaking of success, if you're doing well, if you've had a big win, if you've built something you're proud of, share your story in the comments. You never know who needs to read it today. All right, back to the core message, because this is where it all ties together. People keep asking, why are central banks buying gold if it doesn't save the currency? Because central banks are not buying gold to save your grocery bill. They're buying gold to save themselves when the system recalibrates. Think of it like this. If you own the printing press, you can print the ticket. But if the ticket loses credibility, you want to own something the crowd will still accept. Gold is not perfect. Silver is not perfect. But they are not someone else's liability. And this matters, because the crisis we're staring at is not only about markets, it's about trust. A sovereign debt crisis is, at its core, a trust crisis. It's when the world looks at a promise and says, I'm not sure you can keep that. And once that doubt starts, the interest rate demands rise. The refinancing becomes harder, the deficits become heavier, and the spiral tightens. That's the mechanism. And it doesn't care about politics, it cares about math. Now, there's one more psychological trap I want to warn you about. When people feel fear, they often jump into the thing that already went up because it looks like the winner. That's how people buy tops. The smarter move is to understand the theme and then build a balanced position that can survive volatility. Because yes, gold and silver can pull back. Yes, markets can shake you out. Yes, narratives can flip. But the real danger is not volatility. The real danger is being in the wrong system when the rules change. That's why I keep using this frozen under bright lights image. Most people freeze, they stare, they wait. They think, surely someone will fix this. And then one day, the fix doesn't come. The fix is a press conference. The fix is a temporary patch. The fix is a new program. The fix is another bailout. The fix is another acronym. And the purchasing power keeps bleeding. So the question I want to ask you is simple, and I want you to answer it in the comments, because I want to see where your head is at. Do you think the dollar risk is being underestimated right now? Or do you think this is all exaggerated? And one more thought for your comments. If silver forces a repricing, the fight will be between paper pricing and public confidence in that paper. Pay attention to which side cracks first and why. Now, one more important reminder. By the time you're watching this, a members-only video should already be live. If you want all the updates in one place and a deeper, more detailed breakdown of what I'm tracking, join the channel membership and watch that members-only video. that also tells me who is really following closely, because the next phase will punish casual attention. Now, let me slow this down for a second, because if you only hear one thing today, it should be this. The transition from stable to unstable is not linear. It is not gentle. It doesn't send you a calendar invite. It feels normal right up until the moment it doesn't. And the reason people get caught is because the early stage looks boring. It looks like debate. It looks like analysts arguing on TV. It looks like charts drifting. It looks like a pullback. It looks like just another headline. But under the surface, the plumbing is changing. Here's a simple way to picture it. Imagine a dam. The water behind it represents debt, leverage, and promises. For years, the dam holds. People build houses downstream. They picnic. They forget what's above them. Then tiny cracks appear. Nothing dramatic, just hairline fractures. Engineers say, we're monitoring it. Officials say, there's no immediate risk. Most people shrug and go back to lunch. But the water pressure never stops, and one day the crack becomes a split. That is how sovereign debt crises work. Not with one shocking headline. With years of pressure and one moment of release. So when you see gold holding strong, when you see silver refusing to behave, when you see physical pricing doing things paper pricing can't explain, those are not random anomalies. Those are stress signals. Now, I want to go deeper into the two realities idea because it's the key to understanding what triple-digit silver in a physical hub is really telling you. In a paper market, you can sell infinite ounces with a click. No trucks, no refineries, no vault space, no delivery schedules, just contracts. In a physical market, you can't do that. Someone has to source it. Someone has to move it. Someone has to insure it. Someone has to accept it. Someone has to pay for it. So when physical prices start pulling away, it's like the real world tapping the paper world on the shoulder and saying, nice story, now show me the metal. And here's the cliffhanger. If enough people ask that question at the same time, the market isn't forced to explain. It's forced to reprice. That repricing can happen through higher spot prices, higher premiums, longer delivery times, or tighter availability. And sometimes all four. Now, you might be thinking, but I don't buy metal in Shanghai. Well, true. But prices travel, stress travels. And once a premium becomes persistent in one hub, it tends to show up elsewhere, especially if the underlying issue is supply tightness and not just local demand. This is why people who only stare at a quote screen can miss the real action. They watch the number. They don't watch the flow. And right now, flow is whispering something most people are not ready to hear. The West is used to setting the price. But price-setting power shifts when physical is scarce and trust is thin. Now, let's circle back to the treasury question because it connects directly to the derivative problem. A lot of people assume that if foreign holders sell treasuries, they win. But selling is not the same thing as escaping. When you sell a treasury, you receive dollars. Then you have to decide what to do with those dollars. Do you hold them? Then you're still exposed to the dollar. Do you convert them? Into what? Your own currency. Another currency. Commodities, metals, real assets. Every conversion has an impact. Every conversion moves markets. Every conversion reveals pressure. And here's the hidden issue. The modern global system has been built with the dollar at the center. Even when countries disagree with Washington, they still do business inside a dollar-based plumbing system. That's not a moral statement. It's an engineering statement. So the shift away from that center is not a switch. It's a process. And processes accelerate when fear becomes contagious. Now, here's what I want you to notice. Central banks don't talk like you and me. They don't say, we're scared. They say, we're diversifying reserves. They don't say, we're losing confidence. They say, we're managing risk. They don't say, we think the paper is shaky. They say, we are adjusting allocations. But the behavior is the message. When a central bank increases its gold reserves, it's effectively saying, we want more of the asset with no counterparty risk. That should tell you something. Because central banks are the closest thing to insiders a currency system has. They see the auctions, they see the demand, they see the funding pressures, they see the stress in real time. So when they stack gold, you should ask yourself, what are they preparing for? Now, I'm going to give you a mental model that will help you avoid the biggest mistake I see people make in this environment. There are two games being played at once. Game one is the public game, markets, headlines, indexes, quarterly reports. Game two is the trust game, reserve flows, settlement confidence, debt sustainability, and political stability. Most people only watch game one. Smart money watches game two. Because when game two breaks, game one stops making sense. Now, let's address the gold in the vault misunderstanding again, because this is where the internet gets sloppy and people repeat talking points without understanding the mechanism. If a central bank holds gold, it has an asset, it has a hedge, it has something it can sell. But that doesn't mean the public currency is protected. The only thing that protects a currency's purchasing power in a lasting way is constraint. Constraint can come from credibility, from disciplined fiscal policy, from real productivity, or from a hard backing mechanism like convertibility. Without constraint, the currency floats on trust, and trust can evaporate faster than people think. Now here's the brutal part. To restore convertibility, a central bank would have to do something politicians hate. It would have to force austerity, allow defaults, allow bankruptcies, and let bad debts die. That's why convertibility doesn't return in a gentle way. It returns only after pain, and central banks will fight pain as long as possible. So instead of restoring constraint, they usually choose the path of least resistance. Inflationary solutions, liquidity, monetary expansion, new facilities, new guarantees. These policies can stabilize institutions, but they often sacrifice purchasing power. That's the trade. Now, let's talk about why this particular cycle feels like it could be America-centered, because that concept is extremely important for your positioning. In previous global crises, America was treated as the cleanest dirty shirt. The dollar was the strongest relative shelter. So even when the US had problems, the world still ran toward it. But if the world starts viewing America as the source of the volatility, financially, fiscally, and politically, then the behavior flips. And once it flips, the old playbook becomes dangerous. This is why people who only know one crisis script get blindsided. They assume dollar up in crisis is automatic. They assume treasuries protect is automatic. They assume cash is safe is automatic. But nothing is automatic when the core asset is questioned. Now I want to make this practical. If you're trying to monitor whether this inversion is gaining speed, here are a few things to watch. No hype, no drama, just signals. Watch how treasury auctions are received. Are buyers showing up easily, or do yields need to rise to attract demand? Watch currency moves during risk-off days. Is money still fleeing into dollars, or are other currencies holding up better? Watch gold's behavior during equity stress. Does it act like a true hedge, or does it get sold to meet margin calls? Watch the gold-silver relationship. When silver starts outperforming aggressively, it often signals a shift from quiet hedging to louder speculation and physical stress. Watch premiums and delivery times in your local market. The quote price is not always the street price. Watch headlines about reserve diversification. You don't need exact numbers. You need the direction. Now, here's the cliffhanger. You don't have to wait until all these signals flash red at once, because when they do, the exit becomes a crowded hallway. The time to build resilience is when the room is still quiet. Now, let's talk about the psychology of why people refuse to act. Most people are not stupid. They're anchored. They're anchored to their paycheck currency. They're anchored to their familiar brokerage app. They are anchored to what their friends believe. They are anchored to what worked in the last cycle. And they are anchored to the idea that someone responsible will step in and fix it. That anchoring is powerful. It's also deadly in a transition, because the moment you need speed is the moment your brain wants comfort. That's why I keep pushing you to think in systems, not in headlines. A system that requires continuous debt growth to function is fragile. A system that requires continuous money creation to cover deficits is fragile. A system that depends on confidence while producing policies that undermine confidence is fragile. And fragile systems can look stable, right until they don't. Now, I want to address one more misconception. If a currency loses value, won't stocks automatically save me? Not necessarily. Some stocks can benefit from inflation. Some stocks can benefit from currency weakness. But broad markets can also get hit if earnings compress, if input costs rise, if funding costs rise, or if political responses punish capital. This is why the idea is not all in anything. The idea is balance across regimes. Value and dividends can matter. Resource exposure can matter. Foreign diversification can matter. And hard assets can matter. Because your enemy is not a crash. Your enemy is being trapped. Trapped in one currency, trapped in one narrative, trapped in one assumption. Now, let me hit you with a scenario that could unfold faster than people expect, and I want you to feel the urgency, not panic, urgency. Imagine a period where yields rise because buyers demand compensation for risk. Rising yields make refinancing more expensive. That increases deficits. Increased deficits require more issuance. More issuance requires more buyers. More buyers require higher yields. That loop is self-feeding. At the same time, the currency weakens because the world sees the loop. Then import costs rise, inflation pressure rises. Now the authorities face a choice: tighten to defend the currency and crush the economy, or ease to protect the economy and crush the currency. Most choose to protect the economy in the short term, which means sacrificing the currency in the long term. That's why holding only paper promises becomes dangerous. That's why gold and silver can move in a way that feels parabolic. Not because of magic, because the denominator is changing. Now, let's talk about something most people don't want to admit. When the crowd wakes up, they don't calmly reposition. They lunge. That's why late moves feel insane. That's why charts look like staircases and then rockets. And that's why the best time to build your plan is when your emotions are calm enough to think. Now, let me bring it back to you. You don't need to become a macro genius. You don't need to predict the exact month. You don't need to win every trade. You need a framework. And your framework should answer 3 questions. What happens if the dollar loses purchasing power faster than expected? What happens if liquidity tightens and risk assets drop? What happens if politics gets messy and policy becomes unpredictable? If your plan can survive those 3, you're ahead of most people. Now, I promised you retention, so here's the twist that makes this even more urgent. Central banks can keep the show going longer than people think. They can do it with facilities. They can do it with swaps. They can do it with regulations. They can do it with backstops. So you might watch this and think, okay, but maybe nothing happens for a while. And that's the trap. Because the longer the system stretches, the more violent the snap can be when it comes. So instead of asking, hey, will it happen tomorrow? Ask, am I positioned so it doesn't matter when it happens? That's maturity. Now, one more request, and I mean this. If this video helped you connect dots you hadn't connected before, do not leave silently. Leave a comment, even if it's one word, even if it's our John AG. It's not about ego. It's about proving that original analysis has a community behind it. And if you're one of the people who keeps watching but hasn't subscribed yet, don't wait for the next shock to make you wish you had stayed plugged in. Subscribe now. It takes 1 second. Now, let me close with a final perspective because I want you to carry this with you. Money is not just paper. Money is trust. Currencies are not just numbers. They are social agreements. And when social agreements get strained by debt, by politics, by printing, by instability, people return to the oldest form of financial self-defense, assets that don't require permission. Gold and silver are not trades in that sense. They're insurance against the failure of the promise. So don't let yourself be the person frozen under bright lights, waiting for someone else to decide that the problem is real. Build your plan. Stay informed. Join the WhatsApp channel for daily updates and instant voice notes. Watch the members-only video that's already live for the full update pack. And keep showing up in the comments, because this community is how we beat the low-effort copycats and keep the signal stronger than the noise. If you're still here, you're already doing what most won't, paying attention before the crowd. Stay sharp, stay humble, stay ahead. And I'll see you in the next one. First, subscribe. Short and simple, subscribe. Second, join the WhatsApp channel in the description if you want daily updates and instant voice notes when something breaks. Third, check the members-only video that's already live for a consolidated deep dive. And fourth, comment. Tell me where you stand. Are we in the slowly part, or have we crossed into the all-at-once part?